Hello and welcome to Simply Tax. It's Friday, December 10, 2021, and as we head into yet another year that's again been like no other, the advisors at BKD have been as busy as elves keeping up with the latest developments in the tax world, amid tax law changes, a shifting economy, an ongoing global pandemic, and new regulations. Much like every year, as we've covered in previous episodes 79 and 112 of the podcast, the BKD Year-End Tax Advisor is back again this year with more than 20 articles written to assist you with the crucial year-end planning decisions you need to make, to provide helpful reminders for the year ahead, and to get you caught up on any tax news you might have missed out on. Now, I'm no Santa Claus, so I couldn't manage to get around to covering all the articles in this year's Tax Advisor on the podcast in one night. But I am excited to share with you on the podcast today a conversation I had with 5 of the great contributors to this year's Advisor that was recorded in front of a live audience in St. Louis at BKD's annual leadership conference this year on November 4, 2021. Enjoy!
Trying something a little bit different here, right? So we're doing a podcast episode that hopefully you've all checked out at some point in time. We wanted to do something a little different and do it in front of a live audience. So what that means is we're going to air this later, but here's the interesting part about the live is you can ask questions of our guests live and they'll be on the podcast. So, but really we're just going to give you an inside look at one of our conversations on the podcast, right? And so today we're going to be talking about our year-end tax advisor, and we have 5 guests. They're going to talk about articles they wrote for the year-end tax advisor. So I'm going to call up our first guest, which is Yelena Bosovik. I'll have Yelena tell us a little bit more about herself when she gets up here, but Yelena plays a big role with the year-end tax advisor. So Yelena, welcome to the podcast.
Thank you. This feels like a pageant where you walk across the stage and
that's what I was going for.
You wave.
You can wave, you know.
You say how you're going to change the world.
I think the initial thought was like we'd be kind of like, you know, like a late night show or something, and we could have like the band playing and whatever else. But you know, the band we couldn't make it work. You know, they just
budget cuts.
Yeah, and it didn't fit. So for those that don't know you, Yelena, tell us a little bit about yourself.
I'm a manager in our national tax office, and I primarily spend most of my time on tax legislation, so moderating tax policy out of DC, and then also a lot of the tax thoughtware that goes out to help tell our clients about the legislation that comes out, and also do some quality control risk management, but that's what I do.
You do a lot. You wear a lot of hats. You also speak on, and this is a little, I guess, commercial here as well. We've been doing these live stream talks. So not to be confused with live in front of a live audience, we also do live stream now, Simply Tax Talks. We're doing on Tuesdays at 10 a.m. Central, just kind of covering everything that's happening in Washington. It's been just a whirlwind to try to keep up with everything. So, all right, I have to ask you this question. I'm going to ask all of our guests today this question, but we're going into the holidays. What's your favorite holiday and why?
Probably Thanksgiving. My whole family gets together. I am the second oldest of 11, so we all get together for Thanksgiving for the rare opportunities other than like weddings, and so it's always nice for everyone to be in one place.
Next big question is, what is the year-end tax advisor, and why do we put it together as a firm?
Well, it's actually a pretty cool thing because in my unbiased opinion, mostly because I helped kind of organize it this year, but I think it's helpful for both BKD personnel and also our clients. It's basically an annual publication that we publish online. It's usually around 20 articles on various topics. And the idea is to provide an easy way for BKD people to share some year-end planning considerations, thoughts, updates, what happened in the year, what clients should be thinking about. Just going to have a short thoughtware article for various issues to be able to share to clients to get discussion started with how BKD can help as we near the year end. And it's helpful for clients because, as they scroll through, they can see something and think, oh, I didn't know this was an option. You told me there's this credit for a construction, company. Tell me more. So it kind of helps start a conversation both from a client's perspective and from BKD's perspective.
In addition to putting things together, you also wrote an article on LB&I campaigns. So 10 IRS LB&I compliance campaigns that you should know about. What is LB&I first and foremost?
It stands for Large Business and International Division. It's a division of the IRS that focuses on the tax administration activities, domestic and foreign companies that have U.S. reporting requirements and assets greater than 10 million.
Why campaigns and why should we care about them? I'm just establishing why we should read your article, I guess, before we listen to you talk about your article, if you haven't figured that out.
That's fair.
Yeah. So what's up with the campaigns?
Well, the IRS says they have limited resources. So to help them focus on what actually matters and prioritize what they work on, they've kind of had this shift in the last few years since they released these campaigns in 2017 to focus more on issues versus entities. So they kind of went through and they, prioritized, these are the top things that we want to focus on. So we're going to focus on these issues versus specific entities. And so the list has grown to 53 as of now. And that list is updated. Things come off of it. Some get added in. So I think in 2021, we added 2 or 3 new ones. And so kind of the list changes. But for the most part, it's basically the priorities for this division and what they're going to look at when they're either educating the public or taxpayers about significant risks of noncompliance or what they're going to focus on auditing and kind of their priorities.
Those are good things to know about and care about. So we don't have time for all 53 today, but your article did cover 10 that you should know. So maybe a couple highlights and again, going back to the why, right? Because at the end of the day, yeah, if you want to know why they're significant and why you should be paying attention to them.
Well, I'm not going to give you all 10 because that would, I want people to go read the article.
I would say you got to save some for the article, right? Yeah, okay.
Yeah, this is kind of a promo. There's 10 very exciting ones that we thought were the most important out of the 53 or 54 that are listed on the website. But I'm going to cover just the top 3 or 4 that I think usually impact our client base or people should know about that have been coming up more often. The first one's virtual currency. So those of you who have been following the legislative updates from the Hill, the bipartisan infrastructure bill has a provision in there that requires crypto brokers to report virtual currency transactions and businesses to report crypto transactions over $10,000. And that was kind of a surprise to a lot of people because the crypto industry was kind of unregulated. There wasn't a lot of guidance. But there's actually been an LB&I campaign for a couple of years now on virtual currency. So that's been on their list. Seeing that now there's going to be more regulation, we kind of anticipate that this campaign is going to become a little bit more important and something to keep an eye out, especially if you have clients who do deal in any type of virtual currency. So that's probably one to watch just because we expect more regulation and more information to be coming out, both legislative and from like a regulatory perspective. The other one that we mention every year is the Tax Cuts and Jobs Act campaign, which everyone's like, oh, TCJA is old news at this point. But the IRS has this campaign specifically to monitor how taxpayer behavior changed since this law passed. So they monitor specific returns and kind of issues that they're just curious, like how are people responding to this law? How are they restructuring? What kind of transactions are they doing? So it's more of a monitoring campaign, but they are also weaving in how the CARES Act impacted some of this planning. And so that's something else to keep in mind that the IRS is monitoring this as an ongoing issue for something they want to be aware of to see how taxpayer behavior changed. Another one is S corporations. There's several campaigns related to S corporations. Easy one, I guess, to cover is S corporation distributions. So making sure that those are reported properly, whether it's distributing appreciated property or making sure that a distribution is properly reported as a dividend, if that's the case. So if you go through the article, there's bullet points exactly what the IRS is looking for, but that's some of their priorities and more common ones that we see.
All right, so another important question. Where do I find the Year-End Tax Advisor?
You Google BKD Year-End Tax Advisor, and it's almost always going to be the first search result. I don't know if that happens for me because I've Googled it so much, but I hope it happens for everyone.
Fair enough. If not, I guess you go to bkd.com.
Yeah,
right?
I'm sure it's on there too,
but
yeah. Everyone Googles
I like
things.
the Google, right? And you start there. So it's a good article. I highly recommend it. I'm a little biased, right? I'm a little biased. I think all of your articles are great, so I'm a little biased. But anyway, Yelena, thank you very much.
You're welcome. Next contestant.
The next contestant, we'll call up to the stage. Our next one's another important topic. And Elizabeth, thank you for joining us up here on the stage and navigating the stairs and all that. So again, before we get to the what you wrote about and what you're talking about, let's hear more about you. Would you mind introducing yourself and what you do?
So I'm Elizabeth Hazzard-Herzing. I am in the transfer pricing group, which is a subgroup of international tax. I'm a director. I sit in the St. Louis office, but technically we're like a virtual practice. So I just say we're in the ether, really. We're kind of everywhere.
I like that.
Yeah. So I've been in St. Louis for the past 15 years.
All right. So, I mean, I know I've asked Yelena, so you're all going to know the question, right? But what is your favorite holiday and why?
Okay. So my favorite holiday is Christmas. because our family does a really intense Christmas cookie competition, and there's a lot of trash talking.
Wow.
Yeah.
I was not expecting you to say that. Okay, all right, yeah.
It's intense. We're competitive.
Yeah, okay.
So we don't do athletics very well, but
But you do cookie competitions.
We do cookies.
Okay.
Yeah.
I'm assuming the results turn out well despite the trash talking?
Yeah, I mean, the cookies are always good, but it's like who finds the best cookie recipe?
Ah, okay.
That's what you're going for.
Fair enough. All right. Well, you wrote another great article on global tax reform, pillars 1 and 2. Before we get to that, you ask a question right at the beginning of what is this global minimum tax I hear all about? So what is it?
It's 15%.
All right.
No.
We're off to a great start. Now I really don't want to join in on your cookie competition. Like, you're going to shut me down. Like, this is going to get, it's going to get ugly.
No, but I'll expand if you don't
No,
mind.
well, go ahead.
Okay.
Sure. Yeah.
Okay. The very, even simpler than simply tax would be, that answer is 15%.
That was perfect. Yeah. Okay.
But it really began as discussions of like how to tax the digital economy, because the tax laws have been around for so long and it's so focused on more like tangible goods and just, historic industries. And so when things started going digital with the .com era and, even more so now, like tax authorities never really figured out how to tax these companies. And they, when you look at like social media companies or technology companies and they have billions of dollars of revenue, tax authorities kind of want a piece of that.
It's really kind of trying to solve this problem that's never really been addressed. Because I imagine you have different stakeholders, right? I mean, the U.S. has one perspective. Other countries maybe have different perspectives depending on wherever these services are originating. Fair way to put it? Yeah.
Yeah, and because we're thinking about digital things, you don't necessarily have to have an entity in all the countries where you would have sales or even really like operations. So it's a lot less tangible, I guess.
Yeah, like you can't put your hand on it, Like,
yeah.
Exactly. So, all right, well, there are a couple acronyms, well, probably several in your article, but there's BEPS and OECD. Again, we're keeping it simple here. What are they? Explain those a little bit.
So I'll start out with OECD. And so that's the Organization for Economic Cooperation and Development. My favorite definition of like how to describe it is what The Economist magazine calls it, and they call it like a mostly rich country club. I don't know the whole application process to get into the OECD, but for a while, a long time, it was really just truly developed countries. And now you're seeing, as I say, mostly rich countries. So it's like, kind of lower tiered developed countries that are entering the OECD. And it's based in Paris. And basically, it's an NGO.
Just a quick aside here that an NGO is a non-governmental organization that operates independently of any government and is typically one whose purpose is to address social or political issues.
And they provide economic and tax policies. And because it's an NGO, all it is really just like advice and ideas. It's not anything like enforceable.
Got it.
By them anyway.
Okay, right. So they have to have other people, other countries and government entities sign on to it to kind of give it some teeth.
Yes.
You're saying, right? How about BEPS?
So BEPS is base erosion and profit shifting.
Okay, and what is that?
So that was coined by the OECD. It began in 2013 as an initiative of a way to increase tax transparency and tax fairness. They created 15 action items. And one thing that's nice about the OECD and also slightly scary is that they actually stay to timelines. So they say, we're going to get something done by this date, and they actually do it. So within 2 years, they've pretty much completed all the outlines for these 15 action items with the exception of 3. And that was action items 8 through 10, which related to the digital economy. They basically said, we can't really solve it in this time frame, so we're just going to table it. That's BEPS 1.0. And now this article is essentially talking about BEPS 2.0, which is finally getting to the digital economy and addressing those 3 action items.
You talk about pillar 1 and pillar 2. Can you break down what those are and where things stand? Because I know this is like a moving target, obviously, because the conversations are ongoing here and they're moving towards a targeted timeline. So what are our 2 pillars here and what do you need to know about them?
While this started out as related to the digital economy, really it's going to apply to like almost any type of company, with the exception of basically like extractive companies or financial institutions. So it's still like really applicable, even if you're not developing software and selling it. So Pillar 1 is all about saying, even though you may not have an entity, you're a US-based company, even though you may not have an entity in Argentina and you're having sales in Argentina, we're still going to tax you on those sales. Like, it's giving Argentina a mechanism on how to create tax revenue because that US-based company is generating revenue in that country. Again, that's kind of going back to 2013 when the OECD was trying to increase tax fairness. It also says that not only like you have kind of like proposed ideas of like how much each type of entity should earn. So like if you're a distribution entity, maybe you earn a cost plus 5%, but it's also taking some of the consolidated company's residual income and then allocating it out to the countries where it does business.
It's complicated.
Yeah, so
Yes.
that's Pillar 1.
Okay, all
So
right.
that's the two parts of Pillar 1. And Pillar 2 is the global minimum tax of 15%,
Okay.
kind of creating a mechanism. So basically, any company of a certain size has an effective tax rate of 15%.
Yeah, like you said, just that's a simple one. We can wrap our head around that, although probably not so simple to implement. So maybe what are the significance here, and maybe why has it taken so long, or why have we not landed on an agreement yet?
Originally, 140, or I should say over time, 140 countries agreed to participate in this initiative with the OECD.
Okay.
That's 140 stakeholders right there. And then you include like any of the influencers for each country. So they were able to get 136 countries of the 140 to agree to this plan, which is like really huge.
That's pretty huge. Yeah.
And some of the big countries that were last minute holdouts were Ireland and Hungary. Hungary has quite a few tax holidays right now, and then Ireland has the famous 12.5% corporate tax rate that will be going up. That's just like huge to get 136 countries together. And then if you think about it, part of the idea why this is so significant is you're adjusting all these countries' tax revenues, or you're proposing to adjust their tax revenues, and also one of the ideas is the thought it would help less developed countries where they're having sales but maybe not an entity have tax revenue, and so ideally increase tax revenue in countries that really could use it. But then you also have the idea like all these countries, they're all on different levels of economic development, and not just economic development, but like tax enforcement. So, some countries, they're just trying to collect taxes on cash sales or, increase reporting. And now you're having to like throw all these ideas about how to, implement a global minimum
how
tax.
they would even go about doing that, right?
Yeah.
And the technology and so forth. But so where's the U.S.? Is the U.S. in the 140 and in the 136 you mentioned?
Yeah. The U.S. wasn't involved until about 2021 with the
Uh-huh.
change of administration.
So then that really is and it kind of is tying everything together, and it's really gaining some momentum, I would guess, for that reason, right?
Yeah,
Yeah.
in my opinion, the U.S. joined it helped solidify things more. Because if we wouldn't have joined, you're leaving out like a huge player in the world economy, and you're trying to get essentially global cooperation.
Okay, well, thank you. So check out the article, get more. There's a lot, and then more to go, because there's gonna be more to come, because we're not at the finish line yet.
There's always
So
more to come.
There's always more to come. So
There's always more to come.
So thank you.
Yeah,
Yeah.
thank you
and
very much.
actually, here, let's give her a round of applause. A belated one for Yelena as well. And I'll have Jessica join me up here as well. As we mentioned, it's been kind of a whirlwind of a year, right? At least we're gonna go back domestically again here, and we're gonna look at the 2021 as a year for individuals and kind of what some of the changes were, if you can even remember what some of them were, because yeah, just the mindset shifted so much. But again, before we get there, tell us a little bit about yourself and where you're from.
My name is Jessica Kinnard, and I'm a tax senior manager in the Kansas City Private Client Group.
And you know the question coming, favorite holiday and why?
Yeah, so my favorite holiday is actually Christmas as well, but it sounds like my family needs to step up the game a little bit.
In the cookie department?
Yeah.
And I think all of us probably do too.
I mean, that's one of the holidays that we're able to get most of the family together, and we just play like a white elephant game, and that's probably the last holiday of the year or going into tax season. Normally my New Year's Eve is trying to pack up Christmas decorations and stuff like that. So Christmas, I just get a little bit of a break.
Your favorite season isn't tax season? I mean, or holiday? No?
Maybe
April 15th?
10-15.
Maybe 10-15?
Yeah.
There you go, when you get there. There you go. once you get to the other side of it, I suppose. Right?
Correct. Yeah.
But like I mentioned, yeah, there's so much going on. And in your article, you really did, I think, a nice job of summarizing and laying out all of the things that happen for individuals. But I want to maybe take a deep dive in a couple of them, starting with charitable planning and charitable giving and the related deductions there.
Sure. Yeah. No, that's good to hear because kind of going into the mindset of my article, just like so many things that have changed over the last, year and a half with starting with the CARES Act. So it did some temporary changes for the contributions, and then that was extended into 2021. So for taxpayers that don't itemize, they can actually take up to $300 deduction for cash contributions to qualified charitable organizations. And they can get that benefit without itemizing. So that's nice for taxpayers that might not normally get a benefit for that. And then the change going into 2021 was that married couples are actually able to get a $600 benefit now. So they were limited to $300 per return last year.
That's right. Yeah, in 2020. That's right. Yeah.
And then for 2020, it was actually a above the line deduction. So it reduced AGI. And based upon the draft form, it actually looks like it's going to be a below the line deduction. So kind of like the qualified business income deduction. Not that it's a huge amount, but just interesting that they changed that.
Yeah, that is interesting, kind of moving it on there. So how about those that do itemize? What changes were out there on that side of things?
Yeah, so for those taxpayers that itemize for 2020 and 2021, the AGI limitation for the cash contributions, so cash contributions to qualified charities, private foundations, and donor-advised funds do not count for those. Same with the previous one that we discussed. But taxpayers are able to contribute. It's an election, so they don't have to use that limitation, but up to 100% of their AGI. And that doesn't always make sense to do, but something to, as advisors here, walking through with the clients and making sure that that makes sense for them.
I mean, it's almost like it's an option to effectively not pay any tax, I guess, if you elect to do that and you make the cash contribution, right?
Yeah, exactly. And, it might be beneficial to use up some of those lower brackets for taxpayers.
Yeah.
And if they can have a carry forward or something that might help in future years, just things to look at like that.
I'll shift gears on you a little bit and move over to the child tax credit. And you talk some about that, and there's been a lot of conversation around that. So maybe, kind of what is it and what do we need to know about it?
Yeah, so that probably was the most highly publicized change.
Certainly.
And that is a temporary change. So it really affected 4 different things with the child tax credit. It made it refundable, which it was previously only partially refundable. And it increased it 1 age for children. So children that are 17 can now qualify to receive the credit. The credit is based upon, filing status and modified AGI. So there might be some other limitations, but previously 17-year-olds weren't eligible for that. And then it also increased the credit. So it started out at $2,000, and the increase based upon the child's age. So if a child is under 6, it goes up to $3,600 potentially. And then 6 to 17-year-olds, they can get up to $3,000. In order to get just the cash in the taxpayer's hands earlier, what they did was they made up to 50% of the credit essentially an advance credit. So starting the summer of this year, going through the end of the year, based upon the taxpayers, either their 2020 tax return, if it was already filed when the credit was essentially like projected for them, or the 2019 return, that up to 50% of that credit is being paid out through the end of the year. And then it will essentially be like reconciled and trued up on the taxpayer's 2021 tax return filed in April.
So it sounds like the additional questions we're going to be asking as tax preparers about how much you received and kind of like the stimulus checks, I suppose,
yes,
right?
Yeah, and those were so fun to do.
That was, not fun.
Taxpayers didn't think they received them.
Right.
You follow up with the IRS, they actually did, and they're like, oh, I didn't even notice that deposit.
And actually still getting notices, or at least I am starting to see notices related to people that forgot to mention that they got them.
Oh
or
yeah,
whatever.
definitely.
Yeah.
So supposedly another letter is going to be sent out in January. So hopefully that will be a little bit more timely than some of the stimulus ones. And I think, as tax preparers, there are actually 2 different phase outs with these credits now. So there's one for the increased credit amount, and that's going to be calculated separately than the original 2,000 base. And they are different modified AGI limitations too.
Sounds simple.
Oh yeah, that's how they like to make things. I guess that's job security.
There
though.
you go.
Yeah.
There you go. All right, so we'll shift gears again, and you talk about not so simple, maybe some loss limitations. I know there's some changes there for 21, so tell us about those.
Yeah, so the taxpayer incurred an NOL. There were changes with the tax reform back with TICJA, and then there was the CARES Act that came out and temporarily essentially suspended those changes. So starting in 2021, those NOL limitations are back in effect. So taxpayers can only deduct up to 80% or offset up to 80% of their taxable income with an NOL. And then the rest would be carried forward if the NOL was incurred in 2021 indefinitely. But in previous years, there could be, if you have NOLs coming from previous years, you might have to track those separately because it would be a different carry forward period.
Just kind of, I guess, looking at the environment too, with the tax rates maybe changing or not changing, and managing all that. That's kind of a lot to think about. I don't know. Are you seeing that in practice, and when you're planning here, I guess we're going to year end, about how net operating losses might come into play?
I have not had a lot of taxpayers that have NOLs, but I did have a few that incurred them last year, so they were able to take advantage of the carryback period. Yeah.
Okay. All right.
So, I guess we'll see. Taxpayers don't always know that that's coming. Sometimes they do. I might have a different answer for you when we get into busy season.
I gotcha.
And then kind of along the same lines with the NOL, just kind of loss limitations, the excess business loss, that is in effect for 2021. And non-corporate taxpayers, they can only deduct a net trader business loss up to a certain limit. So for single taxpayers, it's $262,000, and then it's double that for married taxpayers. And just to keep in mind, so if you have an individual that maybe works with the S corporation, their W-2 wages, that does not get factored into the calculation.
That's a sneaky one, the excess business loss limitation.
Yes, yeah.
And maybe it changes too with the conversations we're having going through right now. And because right now, so what happens so it's excess business loss, it's limited. What happens, it happens in 21. What happens in 22 if you were limited?
If you were limited in 2021, going into 2022, you actually have an NOL.
Okay.
So any excess converts to an NOL and it's carried forward to future years.
Gotcha. Under the current law.
Yeah, under the current law, yes.
Okay. Well, thank you. Anything else you'd add before we kind of wrap up on your article?
Yeah, I guess just the last closing thought, to your listeners or viewers, that if they have certain things that come up throughout the year that are a little bit unusual, or, you hear all of these different things on the news, see things on the internet. I think all of us can attest to the fact that each taxpayer's situation is a little bit different. So it's not like a one size fits all approach. And if they have things throughout the year, want to take advantage of stuff like the charitable contribution limitation, they should really reach out to the advisors and get with us on the front end. So maybe we can do some planning and see if that's really a good opportunity for them versus finding out about it in March.
A little harder to do at that point.
Yeah, it is.
Yeah. All right. Well, thank you very much.
Yeah, thanks.
You can call Stacey up. She has a really good question that she was asking in her article. It's a little Shakespearean. Basically, the article covers tax planning through uncertainty to sell or not to sell. Again, you kind of know the drill here. Let's get to know you first before we determine if we're selling or not selling. So yeah, a little bit about you and what you do.
I am a director in Little Rock, Arkansas. I work in private client and accounting outsourcing services. So I kind of split my time on both sides. It's hard to work in accounting outsourcing services without also being on the tax side too. So kind of all hand in hand.
Yeah. All right. So favorite holiday?
I wrote down 2. I did write down April 15th.
That's okay.
But
yeah,
sometimes it's
yeah.
the 16th or the 18th or.
It's a moving target.
I did have a very good friend, former BKDer. She got married late in life like I did. And she called me and she's like, hey, would you be a bridesmaid? I know we're older, but would you mind? And I was like, no, I'd love to. And she's like, well, we're thinking about April. I was like, oh, so it was going to either be April 16th or April 22nd. I was like, well, as long as it's after the 15th. But that was one of the years where we didn't end until the 17th. And so thankfully she picked the 22nd. So she did plan her wedding date around our busy season time. So you got to love friends in public accounting.
Yeah, that's right. You got to check. Yeah,
That's right.
where's the Sunday fall this year? We got to know.
That's right.
Yeah, that's great. Okay, so what's your second then?
Thanksgiving.
Oh, Thanksgiving. Okay.
Yeah, sorry.
All right.
For
That's
food.
good. Coming up.
Food purposes. I also don't have a family cutthroat competition either. But I'm also an only child, so there wouldn't be a lot of competition.
You'd win.
I would win.
It'd be great.
Absolutely.
Yeah. That's the best part of being an
Right.
only child.
That's right.
You always win. Yeah.
Yep.
Now, before we hear more about Stacey's article, I wanted to give you just a quick reminder that this conversation was recorded on November 4th. Although there were some changes as proposed legislation known as the Build Back Better Act was approved by the House on November 18th, the proposals that Stacey and I discuss remain unchanged at the time of release of this episode on December 10, 2021. But as we've discussed on the podcast and previous episodes with guests like Ed Carl and Travis Lucas, we are not at the finish line yet, since it's still a bill on Capitol Hill that's sitting with the Senate as we wait while a few congressmen and women discuss and debate. So to put it simply, stay tuned and make sure that you're subscribed to the podcast as we continue to cut through the static of the evolving tax change world.
We're in a very interesting time here. Uncertainty
Yeah,
is probably
right.
the key word here,
Yes.
right? So let's talk about maybe what proposals we've seen and then maybe how it's changed even within like the last week, we'll say.
Right,
Yeah.
right. So up until last week, we had seen 2 different proposals. We had President Biden's plan on the capital gains rates. So he said, hey, we're raising the capital gains rates all the way up 39.6%, same as ordinary income top rates. Also adding on top of that, the 3.8% net investment income tax for a combined total of 43.4% for capital gains rates. Pretty high. Then the Ways and Means Committee came out and they revised it and they said, okay, we're going to do 25% capital gains rates, still got the 3.8% net in there, but also we've got this 3% high income surcharge. And I can't remember the cutoff on that. I don't know if that was like the 5 million or the 400,000. There were a couple different.
It was 5 million at that
5
at that
million,
point in time.
okay.
Yeah.
Okay.
Yeah.
So that was a combined rate of 31.8%. So getting a little better. So last week,
Last week.
on October 28th, another revision. And so they basically scrapped it. I guess there was not a lot of support for increasing the capital gains rates. We've had some low rates for years. People have enjoyed that. And so we're back to our current rate of 20%. But I think it's my understanding the NIT is still up for debate here on our high income earners. So it could be 23.8% combined rate if you're, I think, over 400,000.
They would change it to the active business would come into play.
Regardless of if you're
right?
active in your business or not.
Yeah.
Exactly.
And so then that would impact you if you're selling maybe whereas it wouldn't ordinarily, right?
Right.
And then now, like you talk about those surcharges, right? So they added in another layer for those over 10 million, I think is right. You get another 5%, and then you add another 3% when you get over 25 million. So yeah, so your capital gains rate when you're over 25 million goes up pretty high there, like to your point. I mean, maybe not to the over 40%, not the doubling before, but
Right. I think we're somewhere in the middle, I guess, now.
yeah. Okay.
Depending on what your high income is.
So I guess, like we said, we've gone from maybe it's doubling to somewhere in the middle. Again, who knows where we land on all this stuff. How do you approach it? And I know you talk a little bit about that and how you could do that in the article. So yeah, what's your take on that?
So we had one of our clients approach us looking toward selling. And so we just did the work. We got the Excel spreadsheet out and we modeled each plan and said, here's what it could look like. In this case, it was a retirement situation. And, are you going to retire early? Are you going to hang in there for a few more years and see if it changes again? The best thing to do is just to plan and see what are the actual dollars in your case. And, is it worth it? Do you say, man, sure isn't cool that I have to pay more tax just because I decided to retire, but absolutely talk to your tax advisors and just see what the numbers look like.
Yeah.
It's one thing to think about it, but until you actually see the dollars involved,
Yeah.
kind of solidifies.
Kind of modeling it essentially.
Exactly.
Because I know in the article you have a really great example of modeling it and looking at what the different proposals at the time looked like, right?
Right. And we thought, well, maybe if we get it in before year end, but all the plans that have come out have said, at whatever date this is signed, it's anything after that, you get the new rates. So there's no kind of hedging your bets on year end planning there.
So I guess with that, now I'm going to ask you so sell or to not to sell. That is the question, apparently. So
Right.
What is the answer?
And so what you learn from a young age in the tax world and public accounting is the answer is always, it depends.
Fair enough.
Depends.
Yeah.
So you got to look at your scenario, look at your case.
Which I know can be frustrating, but it's the truth, right? I mean, 'cause
Right.
there is no one size fits all on that one. That's a good one.
I said, I wrote down, if you can wait for some final guidance to come out, maybe hang in there a little longer if you aren't totally sold on selling till you get those final regs and rules. It's kind of hard to
Know how it'll all
know
work out
what
if
it's
you
going to
can-
look like.
Yeah. Well, great. All right. Well, I'm going to open up again. Does anybody have any questions for Stacey or on the topic? Yeah.
We had a number of great questions that were asked during our session in St. Louis, but much like that band that Yelena and I talked about earlier, we couldn't manage to get them recorded and included as part of this episode. Now, that being said, BKD Director Brian Kapczynski asked a particularly great question that I continue to hear and be asked frequently, so I wanted to give him a quick shout out here and include our response. Brian asked, do you think the capital gains rate increase could find its way back into the discussion on the tax rate changes if the Build Back Better Act is enacted?
Based on some very good Simply Tax podcasts that I have listened to recently, I was in the car for 7 hours last weekend, so I really got to catch up. So
Okay,
it's
okay.
really, really good
We're
listening.
good for that.
Thanks, yeah. But it did not seem to be very popular with our divided situation we have right now. I think the Democrats are trying to get something through, and everybody's got to play together in the sandbox or whatever the cliche is there. But summary last week that came out, it was just not included in the discussion.
No, that's a great question. And, I think, probably nothing's off the table to your point, but
Right.
certainly Arizona Senator Kirsten Sinema was not a fan of tax rate increases. Now, the surtax, you could argue, is maybe a tax rate increase, I
Right,
suppose.
right.
But it's not increasing the 20% rate, so the top 20% rate. So
It's a
I
pretty
don't know.
big split between 400,000 to 5 million as far
Yeah.
as a high income
Yeah.
earner.
Now, and then it's interesting too, because you talk about effective dates, because when they were talking about like the September proposal, it had us, the date of it was released, they said, well, that would be the effective date for the increased capital gains rates, right? And the idea is they don't want to mess with capital markets, because if the capital gains rate's going up on January 1st, well, maybe you're gonna sell something. I don't know. But now what's interesting with this surtax that they're adding, or surcharge for the over 10 million and over 25 million, which, by the way, is only 200,000 for trust and estates and 500,000. So the 5% kicks in at 200,000 for taxable trusts, and you're up to 8% when you get up above 500,000. So you're going to see it a lot sooner. But that would have a 1/1 effective date. And so what's interesting is actually when the joint committee scored it, they actually showed a big revenue increase in year one. So in 2021, year one, but then it actually be negative in terms of the revenue they would raise in the second year, and then it incrementally spiked from there. Because basically saying, well, people may try to game around that. So I don't know. Just sort of an interesting aside, I guess. But great question. Great article.
Thank you.
Thank you.
It's a lot to think
thanks
about.
to everyone. All right. We have our last article here, but that's certainly not the least article. We'll call Amy up to the stage. Who are you, Amy? And we're going for the favorite holiday, but let's hear about you first.
So I've heard.
Yeah.
So Amy Frizzell, I'm in Indianapolis. I'm a principal in our Wealth Advisors group, so a member of the private client team as well.
Excellent. Okay, so favorite holiday.
Oh, it's got to be Christmas.
Okay, so Christmas, yeah, popular. We have three Christmases, right? Did I
Yeah.
do the math right there? I mean, I'm an accountant. It's gonna.
Let's hope you get that right. Yeah.
I hope I get that right, but I would probably need a calculator to make sure I actually got it right, because the math doesn't work well in the head anymore. I
Yeah.
don't know. All right, so you wrote an article that was titled "Retirement Strategies Regardless of the Tax Law."
Yeah.
Which is a good one, because we don't know necessarily what the tax law is going to be next year.
Yeah, I loved it when you asked me to do this. I was like, well, that's great. Like, it's a moving target, Damien.
It's a moving target, yeah.
Right.
Let's try to make it wide open here. So imagine we kind of have to break it down a little bit, right? Because if you're thinking about retirement, you probably think about that a little bit differently, whether you are getting ready for, working towards it, or you're in it. So
Oh,
why
yeah.
don't we maybe take the first bucket of, you're someone that's working towards retirement. What are some things to think about and considerations to be keeping top of mind?
Yeah, sure thing. So there's a couple easy things. So one simple thing, which, don't laugh, is to simply take the free money, kind of think about that. What exactly does that mean? But we actually see this fairly often within our benefit plan consulting group that we have here at BKD, and working with participants. Corporations a lot of times will offer a match, but you'd be surprised the amount of people that actually don't contribute enough to sign up to take the match. Whether you're a high income earner or not, you would be surprised. And so simply take the free money, right? That's step one. That's easy. And then if you are still working, we have a little saying within our group is that we really like to two-step. And so if you're in Texas, maybe you like to two-step as well. But that is where, if you're a high income earner, you can basically backdoor in some savings into a Roth IRA whenever you are over the income limits, right? So you can start off by opening a non-deductible IRA, make your contribution for the year, and then turn around, immediately convert the cash in a Roth conversion, and you get your annual Roth deposit. So it's a nice little step that adds up over time. And so later we're going to talk about taking income when you are retirement. It's nice to have a little tax-free bucket to pull from.
Right, because at that point in time, you've already paid the tax, so it comes out tax-free, right?
That's right. That's right.
Yeah. And I guess you probably should say, like at that one, because that's one that, right, they were kind of messing with you a little bit last week, right? In terms of the tax law proposals. And then they're messing with you again when they added it back in yesterday, or parts of it back in yesterday.
Yeah,
so,
I have to admit, I did wait for a moment last month and thought, well, why do I even need to talk? Because they took out everything.
Yeah.
So
I guess the tax law does kind of play in here a little bit. And
it does,
And
yeah.
I think, right now, at least in the conversation, the backdoor Roth or the
two-step Roth
would not work, because I think that's back in again, but we'll see what they land on.
We'll see where it falls. Yeah.
Okay.
And then one thing I would say, so, a lot of us, if we have children, we want to get them started off well in life. A lot of people don't realize that an adolescent, a young adult, can actually start saving for retirement with a custodial Roth IRA. So having a 16, 17, at the point that you're making some W-2 income, right? Have them save a few $1,000s a year, some of their income that they're earning, teaches them discipline, which is a great point. But when you're investing, time is your friend, right? So those few $1,000s a year that they can put away, and they can do their W-2 wages, $6,000, whichever is less, they can put that in annually. They get to invest that, which is a nice little lesson for them. And then upon retirement, decades down the road, that is actually impactful for them on what that could be. So
well, and then you get all that run, like whenever you do the modeling on like Roth versus traditional and whatnot, I mean, time is your friend.
Time is your friend.
From that perspective, but certainly from an investment perspective too, right? And
right.
the compounding growth and so forth. So.
Right, and then not to mention, depending on what profession they choose and what that looks like, there may be a point in time where they're over the income limits and they can't make a Roth contribution. Well, they've had this period of time leading up, maybe within their late teens or early 20s, early 30s, where then they've had all these savings into a Roth vehicle. And again, you're just looking down the road. That's an impactful tool to have in the toolkit.
And I like how you mentioned too that idea of like it's like an education vehicle too,
oh, yeah.
right? And that's because I know a lot of those that I work with are always wanting to how do I educate the kids? How do focusing on the legacy, and so that's a really good idea.
Yeah, when it comes to wealth management or investing or planning, a lot of it can be brought to is just discipline, right? So teaching that at a younger age is always nice.
So now we're gonna fast forward a little bit here. We've paid off from all of our discipline, and so now we're in retirement. What are some things to consider from that perspective?
Well, good. I mean, it's a good question, right? And so I would say number one is whenever you go into retirement and you start pulling income, first of all, I think having your tax specialist and your wealth management specialist at the table for those strategy conversation is really impactful, right? And you really can get a great amount of value and sitting down and having a cup of coffee together and saying what looks best in my situation. Because like we've said today, a lot of those situations are unique for each client. So one thing would be just to remember, and we see this often when we're talking to some new clients, is that not all income is created equal, right? So you think about, maybe kind of think about like turning on a faucet, right? So I go into retirement and now I'm collecting a paycheck versus savings. And so how is the income and what is the characteristic of that income? And just being mindful of that is really important. For instance, if I'm pulling money out of my IRA, my traditional IRA, maybe it was my 401k, I rolled it over, now I'm taking some income, like that's taxed as ordinary income, right? So we need to think about that. But if I have a taxable account that I've saved to, and maybe I have some stocks in there and those dividends are qualified, then that's a completely different rate, right? So we can just be mindful that not all of your income is created equal. And so when we look at saying, well, how much do I need to retire? That's the first question, and your planner that you use can have some great conversations about that. But then it's saying, well, if I'm going to pull this income, how is the best vehicle for me to pull it from so that I'm the most tax efficient at the end of the day?
And knowing which lever to kind of pull and thinking about the big picture.
Yeah, absolutely.
Yeah, and is it kind of multi-year too, kind of looking out over the time horizon of retirement? Is that the best way to do it?
It is, and it changes from year to year. Life happens,
Right.
right? And so it's just saying, okay, well, when I'm looking at it for the current year, what makes sense? And again, we have years like today where there's a lot of unknowns. So there's a lot of, well, if maybe we might, but we don't quite know conversations. I think it's just being really flexible to be able to have that team together, right? And just say, okay, things are morphing, and so what makes sense this year?
Think about that things aren't equal. Any other considerations for those that are in retirement?
Yeah, so one thing, and again, I think this is kind of a big picture thought. So it's really important when you're there having that cup of coffee, because you and I, we both love coffee, Damien.
Certainly. You need to have, got to have the caffeine.
Oh,
Yeah.
amen to that. So when we're there, talking about really fully utilizing your tax bracket, and by that, I mean having your tax specialist there and saying, okay, I'm pulling income. Does it make sense that I pull excess income to soak up the room I have left in my current bracket? And that could be just a big picture strategy that we want to deploy. And again, I think it's important to have all the parties there, and because it changes from years to year.
And why would you, sorry to interrupt, but why would I want to soak up the tax bracket? What's the advantage of doing that, I guess?
It's just the idea that we're repositioning assets, maybe from a legacy perspective. So we're going to reposition, move those over into a taxable account where we're getting some different, again, characteristics that we can choose from an income perspective, or even an investment perspective.
Okay. All right. So so I like it. So this intersection of tax, you got to give your tax advisor and your investment advisor in the conversation.
Yeah, I want to go down that road solo. I really think that's one that you bring the team along. And then I guess with that vein of thought, you really could look at saying, especially if you have, from a legacy planning perspective, if you have large retirement accounts out there, does it make sense to do and have a conversation about annual partial conversions? And again, the idea of soaking up brackets, right? So does it make sense that I convert a little bit of my IRA from a traditional bucket into the Roth bucket, right? And maybe that's a leave asset that I know I'm going to pass down, especially since the Secure Act. There's some planning from a wealth transfer perspective that we could really look at that, but that's a conversation that you need to have the whole party.
Yeah.
Attend.
Well, yeah, because those are complex computations and modeling to do, right?
Absolutely.
Yeah.
And that's a year by year case. So that's the nice thing about it. You're not putting anything in concrete. You make a decision this year, it made sense. Life changes next year, maybe it doesn't. And then the following year, maybe it does. You can have that time.
So anything else that you would add from your article was, I thought really nice how it kind of broke down those buckets. Anything else, closing thoughts otherwise you'd add there?
Closing thoughts, the only thing we haven't mentioned is from an IRA, if you're philanthropic, charities, you do have the ability to do a QCD.
Absolutely.
Right, so do a qualified charitable contribution, and you can just go make a gift direct to the charity, 501c3, so not the Damien Martin Retirement Fund. So it's got to be
Yeah.
good to
I was
know.
just trying to make a plug for that, but we'll leave that aside. Okay.
Right.
All right.
Yeah, but you could make a gift straight to the charity from your retirement account. You can do that up to $100,000. So once you're on required minimum distribution.
That's a powerful one.
It can be, yeah. Charity gets the benefit that you purposely want to do. You're not having to count it as income. You may not get the deduction, but at the end of the day, not counting it income is pretty powerful.
Well, yeah, and even when we think about going back, so my mind's really thinking about these surtaxes and charges, so that because that's actually you're looking at modified adjusted gross income. So you really want to have just you want that out of your income if you're looking at those taxes, because so that way you're not subject to this. You don't trip that surtax. So.
Right. Yeah.
All right. Well, this was very helpful. Thank you, I guess, to all five of you and to all the authors of the Tax Advisor. I mean, we just scratched the surface here today, really. I mean, there is a lot of really good stuff in there. Hats off to you, Yelena, for helping to put that together. Thank you for joining us today, and thank you for listening.
Thank you.
Well, I certainly took a lot away from the episode today, and I hope you did as well. I'd say my top 3 takeaways are: 1, watch out for Elizabeth if you ever find yourself in a cookie competition with her. 2, tax planning is particularly challenging this year, and discussing and modeling your personal situation is the key to help you navigate the uncertain environment. And 3, planning for retirement, whether it's years away or you're already enjoying it, is important regardless of the changes to the tax law, and it takes a conversation with your entire team of trusted advisors to be effective. I'll invite you to learn more about our guests, read their articles, and check out the other great insights in the BKD's 2021 Year-End Tax Advisor with the links that we've included in the show notes of this episode that are available at bkd.com/simplytax. And I'll make one more plug if you haven't already. Subscribe to our Simply Tax YouTube channel and follow us on LinkedIn so you don't miss out on our Simply Tax Talks live stream to help you stay current on the latest developments on the potential for significant tax change this year. Join us live every Tuesday at 10 a.m. Central as we continue to monitor and report on the developments related to the Build Back Better Act. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.